host today's webinar on petrochemicals navigating through a challenging phase. Thank you for taking the time to join us. Before we begin, I'm delighted to introduce our esteemed panel members of the day. Mr. Gopal Thakkar, Chief Financial Officer at Deepak Chemtech Limited. Mr. Pramod Kumar Gupta, Chief Financial Officer at Haldia Petrochemicals Limited. Mr. S.G. Venkatesh, ED Petrochemicals at Indian Oil Corporation Limited. For an unprecedented commitment, Mr. Venkatesh could not join us today. Moving forth, this session will be moderated by Mr. Hardik Shah, Director at CareEdge Ratings. We will begin this webinar with a presentation by Rapin Bihani, Associate Director at CareEdge Ratings. Following the presentation, we will move into a panel discussion, followed by an audience Q&A. For any questions, please type them into the chat panel. We will address them towards the end of the session. With that, may I invite Rabin Bihani to kick off the proceedings with his presentation.
Thank you, Mamta, for the quick introduction. Good evening, everyone. I once again welcome our elite panel members who have joined us today. Let me begin the presentation with the key messages. India's petrochemical industry is expected to witness a steady volume growth in FY26 on the back of robust demand for the products. Prices of petrochemical products are expected to remain under pressure due to weak global growth prospects, excess supply in the market, and lower crude oil prices resulting in lower input cost. Despite expectations of continued subdued prices, operating profit margin could see a marginal uptick in FY26, given that we saw some green shoots in H1 FY26. Domestic players have outlined a large capacity expansion in the key petrochemical products, which is expected to reduce high import dependency on major petrochemical products and aid in India's self-sufficiency. While import dependency is expected to decline, achieving optimum operating profitability would be critical on the back of high supplies from China. And lastly, going forward, ongoing geopolitical uncertainties, US tariff, supply chain realignment, currency fluctuations, adverse movement in crude oil price shall remain a key monitorable for the sector, besides the pace of capacity expansion in China. We have broadly divided today's presentation in five key segments. A, scenario of Indian petrochemical industry, wherein we shall discuss the domestic consumption, imports, product-wise import dependency, and major trading partners. B, details of major capacity expansion plans in the industry. C, trend in petrochemical prices and spread over the last 7.5 years. D, growth outlook and capacity expansion plans globally. And finally, E, industry operating performance trend over the years. Let's begin with the scenario of Indian petrochemical industry. Consumption of major petrochemicals comprising of polymers, including PP, HDP, LDP, LLDP, PVC, aromatics, and elastomers, have witnessed a healthy growth over the past few years. As we can see from the chart on the left side of the screen, after witnessing a decline in consumption in FY21 in view of COVID-led disruptions, consumption witnessed a strong growth over FY22 and FY23 on the back of pandemic-led demand for plastics. The growth continued to remain healthy in FY24 while it slowed down in FY25, it broadly tracking the domestic economic growth. Growth in consumption is expected to remain at similar levels in FY26 vis-a-vis FY25. Overall consumption volumes of the key petrochemical products is estimated at 29 million tons for FY26. The pie chart on the right side of the screen shows the product-wise consumption of various petrochemicals. Polymers remain the major consumed petrochemical, accounting for about 3/4 of the total demand. India remains dependent on import to meet the domestic demand for petrochemicals. On the left side chart, we can see from an average import of about 6 million tons during FY19 to FY22, product imports have increased substantially in FY23 and FY24 on the back of availability of cheaper imports consequent to large global capacity expansion. Such elevated imports in FY23 and FY24 have impacted the capacity utilization of the domestic industry, as can be seen in the chart on the right side. Capacity utilization declined in FY23 and FY24 with decline in imports, while it improved marginally in FY25 on the back of decline in imports. Now, this decline in imports in FY25 was on the back of decline in imports of polyethylene due to imposition of quality control order from January 24. Import volumes in FY26 is expected to remain at a similar level of FY25. Accordingly, domestic capacity utilization is expected to improve marginally, led by growth in consumption in FY26. Moving on to details of product-wise imports, here we have captured trend of imports for all the petrochemical products as a percentage of the domestic consumption over the last 3 years. Combination of factors including strong consumption growth, absence of domestic capacity addition, and cheap imports have led to sharp surge in imports over the last few years across all the products. Domestic market remains dependent on imports for major consumed products including PVC, polypropylene, and polyethylene. In the PVC segment, India has a large dependency on imports, with about three-fourths of the requirement being met through imports. For polypropylene and polyethylene, which are the other major consumed products, import dependency stood at about fifth of the consumption, while for ABS and elastomers, about half of the consumption is met through imports. Having looked at the extent of the product dependency, let's look at the major trading partners of India for the imports of key petrochemical products. While India continues to rely on imports across all major products, there are a couple of products which are exported, which is highlighted in gray. UAE, Saudi Arabia, Korea, China, Taiwan, and Singapore remain the major petrochemical trading partners for India across different products. The top 5 trading partners account for 60 to 100% of trade for different products. On the backdrop of this substantial import dependency and growing consumption, let's look at the capacity expansion plans which have been outlined for the domestic players. Domestic players have outlined a large capacity expansion across different product segments, especially in PVC and PP, which is expected to enhance the domestic capacity substantially. Polypropylene capacity is expected to increase by 1.7 times, while PVC capacity is expected to increase by 2.5 times from the existing capacity. While domestic market, despite the large capacity expansion, is expected to continue to remain reliant on imports for meeting the domestic requirement, given expectations of continued healthy growth in consumption, the large capacity expansion nonetheless is expected to gradually reduce the import dependency of the country going forward. Especially for the polypropylene, there could be a sharp drop in import reliance to near about nil levels by FY30. Here we can see the major capacity expansion plans across the different product segments for select few companies. This capacity expansions are in the form of both greenfield as well as brownfield, with the feedstock as naphtha and natural gas. All the major petrochemical companies are expanding the capacity, which is expected to be implemented over the next 4 years, leading to reduced import dependency in the long term. Having looked at the overview of the petrochemical sector and the expansion plan, let's delve into the prices and spreads of the key petrochemical products. The top right chart shows the volume-weighted trend of petrochemical prices over the past 30 quarters, and on the left side, we can see the crude oil price chart for the similar period. From this, we can observe that petrochemical prices have remained depressed over the last 3.5 years, while exhibiting some correlation with crude oil prices. In the top bottom left chart, we have provided the spreads of ethylene and propylene from naphtha cracking, given that these two are the major building block products, whereby we can see that the spreads have remained subdued for the last 3.5 years. On the right bottom chart, we can see the crude oil prices and petrochem. We have put the crude oil prices and petrochemical prices has been indexed to 2019 levels. Here we can see that the fall in petrochemical prices have been reasonably higher than the crude oil prices, which has impacted the operating performance of the sector. Having looked at the trend of prices and spreads, let's move on to understand the key reasons for such sharp decline in prices and spreads. The decline in prices have been due to product oversupply, led by significant capacity additions in China. The top chart shows the global ethylene capacity addition, and the bottom chart shows ethylene capacity addition by China. Global ethylene capacity have increased to 231 million tons in 2024 from 183 million tons in 2019, out of which substantial capacity addition have been done by China in each of the years. China's contribution to total capacity addition has been as high as 66% of the global capacity additions. Such large capacity additions continue to remain unabsorbed amidst subdued global domestic demand growth in China, as well as weak global demand growth, which has created a large product oversupply in the global market, resulting in weak prices and spreads. Even in calendar year 2025, there is a large global ethylene capacity addition planned, which is expected to be largely contributed by China, which could result in limited improvement in prices and spreads in the near term. Now, moving on to the trend of prices and spreads for the products under olefin and aromatic segment. In the top chart, we can see the spreads of polypropylene and HDPE vis-a-vis the naphtha, which has remained weak till Q2 of financial year FY26. In the bottom left chart, we can see there is an improvement in PVC EDC spreads in first half of FY26 and especially in second quarter of FY26. Whereas in the bottom right chart, we can see that the polystyrene spreads continue to remain weak. Having looked at the spreads over the years in the olefin segment, now let's look at the spreads of the product in aromatic value chain. While spreads of the olefin segment have remained under pressure, spreads of aromatic value chain products have remained relatively better, led by better downstream product demand and limited oversupply in the market. Spreads of the benzene on the left side have remained healthy over the years. However, in the past 2 quarters, spreads have contracted, led by surplus capacity and weak demand, which though is expected to normalize going forward with the absorption of capacities. Spreads of paraxylene on the right side have remained healthy in the absence of large capacity additions and is witnessing an uptrend in recent quarters led by increasing downstream demand on the back of recovery in the textile products. Now, here we draw a comparison of domestic prices and import prices of various petrochemical products, including polypropylene, HDPE, PVC, and ABS. Import prices have been represented through dark blue color. Across the products, while the trend of domestic prices and import prices remain similar, import prices have consistently remained lower than the domestic prices, which has led to increase in cheap imports and have thereby impacted the domestic industry by the way of pressure on prices and decline in capacity utilization. Let's move on to the next segment of presentation and understand the global growth and petrochemical outlook. The top left side chart shows the trajectory of world economic growth and growth expectations of major economies. World GDP growth is expected to decline in calendar year 25 and 26, led by weak growth across major economies, including United States, China, and Euro region. India's growth too is expected to remain low in calendar year 26 vis-a-vis calendar year 25. On the top right side chart, we can see the expectations of crude oil demand and supply. From balanced demand-supply equation, oil supply is expected to be higher than the demand, led by higher production by OPEC, which coupled with weak GDP growth outlook is expected to result in benign crude oil prices in 2026. Average crude oil prices is projected to remain at around $66 per barrel in 26. Moving on to global petrochemical outlook and capacity additions. The top two charts show the expectations of capacity additions in the olefin segment, while the bottom two charts shows the expectations of capacity additions in the aromatic segment. In the olefin segment, large capacity addition have been planned to be added globally by capacity additions in China, which is expected to keep the operating rates under pressure in the medium term. However, with the low capacity additions planned in benzene and paraxylene segment, operating rates are expected to remain favorable in comparison with the olefin segment and is expected to keep the product prices and spreads favorable, whereas prices and the spreads in the olefin segment is expected to remain under pressure. Having seen the growth trend in the sector, demand-supply equation, import dependency, and movement in spreads, let us now look at the past operating performance of the players and expectations going forward. The left chart shows the trajectory of the revenue and growth. After having witnessed a strong growth in revenue till FY22, fueled by strong growth in consumption and strong prices, revenue growth has declined and have remained subdued since FY23. This has been primarily on account of the weaker prices, even though consumption growth remains healthy. The right chart shows the trajectory of the EBITDA margin. Contraction in the spreads have led to sharp decline in EBITDA margin. EBITDA margin have contracted over FY23 to FY25 and have remained at a low single digit, impacting the overall return in the sector. During first half of FY26, there has been a marginal uptick in EBITDA margin, which is expected to support some improvement in margin for FY26. Even though revenue is expected to witness a moderation on the back of decline in product prices due to pass-through of decline in feedstock prices. Now let's look at the segment-wise operating performance for the players. Top chart shows the performance of the polymer players, while the bottom chart shows the performance of the players other than the polymer manufacturers. As seen earlier in the presentation, spreads of polymer players have witnessed a substantial contraction vis-a-vis the other petrochemical products. This has led to sharp erosion of EBITDA margin for polymer manufacturers over FY23 to FY25, and it continues to remain substantially lower than the previous reported levels, especially pre-pandemic year. While EBITDA margin of non-polymer players have remained relatively satisfactory in comparison, and the players continue to do well. Moving on to the last segment of the presentation, let's look at the sector outlook and the key monitorables. For the outlook, healthy domestic demand is expected to ensure steady growth in petrochemical consumption in FY26 and onwards. Looking at India's very low per capita consumption of petrochemicals, consumption is expected to grow in the medium to long term. Sizable olefins capacity addition, especially in China, is expected to keep the operating rates under pressure, while lower capacity addition in aromatic segment is expected to support the operating rates. Large capacity expansion plans in the domestic market is expected to support reduction in import dependency over the long term. Weak global demand amidst high supply shall continue to keep the prices and spreads under pressure in the near term. Decline in feedstock prices shall remain a tailwind for the industry. Operating profit margin could see marginal uptick in FY26, likely supported by favorable ethane cracking. The key sector monitorables would be, while the crude oil prices have softened and likely to remain range-bound going ahead, impact of recent sanctions by US on two Russian oil companies would be one of the key monitorables. Recently, government has announced a rollback of quality control orders on various petrochemical products. The impact of the same on imports and petrochemical prices would be critical. Potential impact of ongoing geopolitical challenges, US tariff and realignment of supply chains. Potential impact of news related to closure of few refinery and cracker plants in Europe and Northeast Asia on a global supplies and prices are the other key monitorables. We saw in the presentation earlier that supply from China is outpacing its domestic demand, leading to pressure on the sector. Additionally, recovery in the domestic demand of China and absorption of additional capacities would be important for any meaningful improvement in spreads of the petrochemical products. And finally, the implementation and progress of China's anti-involution campaign would be the last monitorables. With this, I conclude the presentation here. Over to you, Mamta.
Thank you, Rabin, for that comprehensive overview. A quick reminder to all the attendees, please keep sending in your questions. We'll take them up during the Q&A. Now, I would like to invite our moderator, Hardik Shah, to take the discussion forward. Mr. Hardik Shah is a qualified chartered accountant and a CFA, currently serving as director and ratings head at CareEdge Ratings, and has over 19 years of industry experience with a focus on corporate credit ratings. At CareEdge Ratings, he has led various ratings teams across diverse sectors. Over to you, Hardik.
Thank you, Mamta, for the quick introduction and Rabin for an insightful presentation. Good evening and very warm welcome to everyone who has joined us today for this webinar. We welcome our esteemed guest speakers for today. Let me introduce them in an alphabetical order. Our first guest speaker for today is Mr. Gopal Thakkar. Mr. Thakkar is a Chief Financial Officer of Deepak Chemtech Limited, a major company within Deepak Group, where he is a key driver of financial strategy and operational excellence for the group. With over 20 years of experience, Mr. Thakkar is a recognized expert in corporate finance, strategic planning, and large-scale project management. He has been with Deepak Group for the last 13 years, and prior to that, he has worked with JM Financial and Binani Industries. Mr. Thakkar is a commerce graduate and he holds leadership and advanced financial strategy certificates from Indian Institute of Management, Ahmedabad and Bangalore. A very warm welcome to you, Mr. Thakkar.
Thank you. Good afternoon to all.
Our second guest speaker for today is Mr. Pramod Kumar Gupta. Mr. Gupta is a Chief Financial Officer of Haldia Petrochemicals Limited, a major integrated player from the eastern side in petrochemicals business. He joined Haldia around 2 years back, and before that, he has extensively worked with renowned companies including Unilever, Conagra, DHL Express, Novartis, Microsoft, Rivigo, and Arvind Fashions Limited. With over 27 years of experience, Mr. Gupta is a commerce graduate and a qualified chartered accountant. Very warm welcome to you, Mr. Gupta.
Thank you so much, Hardik. Look forward to the discussions today.
Our third guest speaker for today was Mr. S.G. Venkatesh. He's an executive director petrochemicals with Indian Oil Corporation. And as mentioned by Mamta initially, due to some personal exigency, he is unable to join us for this webinar today. And he has expressed his sincere apology for the same. My sincere thanks to our guest speakers for joining this session, and it's time to quickly set the context before we begin the discussion with the panel members. So we saw in the presentation that over the years there has been a healthy growth in the petrochemical consumption, especially till FY24, and then growth in the economy has slowed down, and simultaneously the consumption has also slowed down a bit in FY25, and it is expected to remain at a similar level even in the current financial year. However, in the absence of any major domestic capacity addition during this period, imports have gone up significantly, as we saw. Going forward with the planned capex in the petrochemicals, we expect import intensity to moderate. However, due to narrowing spreads, essentially due to threat of cheaper imports, profitability of the sector has come under real pressure in the last 3 years, which ended FY25. While we saw some green shoots in current year first half numbers, in this backdrop, we would like to know the views of our today's panel members on some of the pertinent topics. So with this, my first question is to you, Mr. Thakkar, about how do you see the petrochemical consumption growth going forward? Because everything ultimately hinges on the consumption. We saw there is some slowdown in consumption in last 2 years, but going forward, how do you see the consumption pattern? Over to you, sir.
So, as far as the petrochemical industry is concerned, especially on the consumption side, we see a robust demand across board. We have seen a lot of initiatives has been launched by Government of India in last few years, which is really creating a lot of tractions, like PLI schemes for electronic segments. Recent announcement on GST front, where the across industry is getting benefited, especially automobile sectors. A lot of infrastructure related investments are happening across the board. And of course, we are the fastest growing economy globally. As your colleague was showing presentation, India is expected to grow more than 6% next year as well. So we see a good opportunity. India I believe, is the fastest growing petrochemical demand central globally. Though China is achieving self-sufficiency, India will be the next best option for anybody to sell their petrochemical in India. And hence, one of the reason of imports is that India is very attractive for them to sell whatever the self extra capacity they have to put in markets. So yes, I'm seeing a good opportunity for anybody to sell petrochemical in India.
Right. Having understood that the consumption is going to be good, I would request Mr. Gupta to add additionally what all additional factors you see could be a key growth drivers for the consumption, at least in the medium terms, the next 5 years or so. Basically, because there are large capacity additions which are already planned by both public and private sectors. So, what could be the key growth drivers for this consumption?
Actually, in many ways, Rabin as well as Mr. Thakkar have covered lot of it. So, but let me add a couple of things to that. GDP growth is obviously a very, very major contributor. Within GDP, if we were to see and Mr. Thakkar also touched upon the PLI scheme, but overall, the whole manufacturing focus that is there, manufacturing, if GDP itself is manufacturing growth led, then the consumption of all the key raw material, ultimately petrochemicals are like steel and cement and all, they are the basic building blocks. So therefore, the focus on manufacturing The other part is the whole constitution of the GDP growth. There is investment in real estate, there is investment in infra, the whole within the services sector, the travel, out of home, all of these are highly basic inputs led growth. And therefore, the expectation is that intrinsically the growth of the basic inputs, the basic, raw materials and basic building blocks is likely to be higher than the GDP. I also saw in Rabin's charts that that growth has dropped to 5% in FY25. One of the things in FY25 that also happened was I'm talking about polymers specifically, that in FY25 there was a very significant drop in the Jal Jeevan Mission operations across India,
Yes.
initially driven by the elections followed by monsoons, etc. So therefore that did have a very significant impact, and that some of that impact continues this year also, because central government is looking at certain changes in the way funds are allocated on the Jal Jeevan mission. But I guess it is a bit of a transitionary kind of a thing, and we do expect the growth going forward might be a little higher than that, but let's see.
Right,
And the
right.
other thing about beyond, if we were to go beyond polymers, uh, if we were to go further down to the downstreams of the chemicals, like when you crack naphtha, while let's say two-thirds of the product is polymer, but there is also that sorry, around 60% of the product is polymer, but 40% is chemicals, and those chemicals, they have opportunities to go further downstream. If we were to look at within India, the downstream products, when you go further down from the basic building blocks, are mostly imported. So therefore, if as India itself goes further and further down in the downstreams, there will be significant growth opportunities for petrochemicals beyond polymers and the first level of chemicals that come out of the naphtha cracking.
Absolutely, absolutely. And it should also improve the profitability as you go into down the value chain, value-added products.
Absolutely.
Uh,
Because as Rabin also covered in his presentation, that while polymers are impacted very significantly, because on one hand there is a China slowdown, on the other hand because of the Russia-Ukraine war, the crude prices went up, and more than that, the naphtha prices went up. The downstreams are not that significantly impacted, and therefore there is a better profitability.
Right, right. You very well highlighted the point related to Jal Jeevan Mission. We also read couple of our clients in the construction side in the Jal Jeevan Mission. So we also hear that, but I think those issues have been more or less sorted. I think probably a quarter or so down the line, we could see some momentum is what we understand from the
Sure, because
players.
other sectors have been anyways growing, and Jal Jeevan Mission having already been around a year, that is already built into the base. So
Right,
therefore, if Jal Jeevan improves, then actually it will have further fillip on the growth side.
right, right. Thanks. My next question is to Mr. Thakkar, is on the capex side. We saw in the presentation sizable capex is planned by Indian companies, both from the public sector as well as private sector in the key petrochemical products. So, in terms of execution of this project, do you really see any major challenges in completion of this planned capex in the medium term?
Yes, so yes, Hardik, I think it's very excitement time for petrochemical industry and the capex inside. I'm seeing almost 35 to 40 billion investment plan because realities. Uh, Major challenge on the capex side, investment is of course labor issues. Uh, uh, Last year we have seen very heavy monsoons, so El Nino effects also creating a lot of challenges. And third is, of course, we see that government is putting a lot of efforts to see that they will create a lot of infrastructure for a medium-sized company to come up and put up the capexes. So I think, as you rightly said, that as you go downstream, your risk of margins go down. And so a player who has an integration or player who has a customer base next to them, they will be more immune than those only producing the limited molecules. So yes, capex cycle is there. Seeing that lot of investment by government for PCPR kind of regions, and creating a right infra, creating right utilities, creating blocks, creating boilers and roads and water availability. That will be helpful for industry to put more and more capexes. Uh, other issues we are seeing this, of course, which is on the land acquisitions and logistic connectivity. But I think these are all surmountable, and government is working on that to see that right company given the right timely approvals and clearances.
Right.
Third portion is, of course, on the front on the ESG side. Uh, uh, Stricter norms on the carbon emissions is also creating a lot of, of course, there's one side is that, we are seeing a lot of investment in solar and other energy sectors, but at the same time, we have to be very competitive. So you have to balance in the right way.
Yeah. Absolutely. In terms of financing, do you really see any challenges because the size of capex, which you said 35-40 billion? So, financing, do you really see any challenges, especially considering the large size, while the banks are sitting on a sizable liquidity today with a lot of infusion from the government side? So, do you really see financing as a challenge for this capex?
Debt financing is of course not a challenge. Those who are having a deleverage balance it. So people like company like us who has a good run in last few years. Yes, we were net debt free company practically on 31st March 25. So that's not a big challenge. Banks are really supporting, but those who has a slightly levered balance sheet has definitely a challenge. But we are seeing both equity and debt market is very active today. So capital is not going to be a big challenge.
Right, right. Thanks for this. My next question is to Mr. Gupta. Having large capex already lined up by Indian companies, and we see some weakening in terms of performance over last 3 years consistently, the performance had been weak. What kind of support is expected by the industry from the government side so as to have a healthy profitability, which can ultimately justify the plant capex? Ultimately, corporates will always look at the return on equity.
I think there are two, three parts. Definitely, one of the parts that Mr. Thakkar already touched upon in terms of the ease of doing business, whether it is land acquisition, approvals, make them as frictionless as possible, etc. And then PLI kind of schemes are anyways there. But I think there are, apart from focusing on exports, government should also look at saying that how do I make sure that the projects which are long gestation and which are like China is saying that I don't care beyond the point for the IRR. I just have to make sure that I'm self-sufficient, and therefore for that government, Chinese government is doing whatever that is needed to make the country strategically self-sufficient on key items. So similarly, our government also needs to look at what is it that needs to do in terms of making sure that when there is a global downturn, Indian industry is not impacted by the short-term winds of dumping, or somebody has already got the capacity and then they have to sell. Then India is anyways a growing market, and therefore they will just dump into India. So those kind of things, while I mean, we are in favor of free trade and all of that, but free trade should not mean free for all. And in that context, the short-term wins or even the medium-term wins of outside the country, excess capacities should not impact the Indian, key industry players. So in that context, the kind of protections that are needed, especially against dumping through anti-dumping duties or safeguard duties, where there are intrinsic differences in the cost structures of Indian as well as global companies. And While we did talk about the land, etc., one of the key things that is there for industry like ours is power, and power reforms have been relatively sort of fragmented across the country because the state governments do have a very large play. So therefore, there are states where the power reforms have not yet percolated, which make the cost structure of the industry very high. So these are the couple of things that I would mention. The whole QCO withdrawal is anyways negative for the core industries like ours because that opens the floodgate for relatively cheap and substandard products. There are enough consumers within the country on the of the intermediate and the final product the producers who do not mind compromising on the quality as long as they get even if they get substandard products at a cheaper price. So therefore, some form of quality control compliances as well as duty protections against dumping and intrinsic cost differences.
I think
That's
yes,
what I.
that's one of the key aspects. I think we have to see that because across board, from the top-notch countries to the medium-sized countries, yes, supporting the industry by way of providing all sorts of benefits, including the duty supports. And I think this is one of the big ask from industry today.
Yes.
Right. Obviously, yeah, because there is a vision to become a self-sufficient, but you will have to also take care of the industries when they set up such large capex. Then probably to protect them is also one of the national duty. I agree to that. My next question is to you, Mr. Thakkar. We saw in the presentation there is some improvement in the profitability in H1 of current financial year, April to September period. While spreads continue to remain weak for most of the products except PVC, as we see. So, according to you, what are the reasons attributable to this improvement, and to what extent these are probably sustainable in the near to medium term? Is it because of the ethane cracking compared to a naphtha cracking, or any other reasons, according to you?
So we see definitely see, as I said, consumption is good. Uh, uh, there always be a time where input cost is very high. So I think in presentation, Robin has highlighted, yes, that benzene price has gone down, naphtha has gone down. So of course, this helps some of the industry players in terms of the margins. But we continue to see risk from the China front, where the capacity China has become self-sufficient and they continue to produce, and so other Asian players has to sell their material to good market, and India is very attractive market for them. And so we continue to see that imports keeps coming from various places, from including China, Thailand, Singapore, or Taiwan. So that risk is there. Uh, but the major reason for a better last H1 is, of course, is lower input cost. And second is, though imports are coming, this shipping related issues, especially supply chain, the Suez Canal, Red Sea Canal issues, keeps benefiting to Indian producers. How long it will run, we don't know, but yes, it helps. So sometimes something goes wrong in other country, it helps to us.
Right, right. So multiple factors, as you highlighted, have contributed to this performance. Agreed. My next question is to you, Mr. Gupta, is on the emerging technologies. Which are the emerging technologies which are transforming the petrochemical production efficiency, and your views on readiness of the sector to shift to such technologies? One such technology which we understand is historically we have been a kind of a petrochemical being produced through refining route. So there is a oil which comes, you refine, and then there is a petrochemical which mix. But we hear a lot about the direct oil to chemical petrochemical plants, O2C typically we call it. So how do you see the O2C technology? Because we understand there is a significant energy saving cost and the yield is also very high. while bypassing the refining is probably one issue because it balances the refining side as well as petrochemical. So, but direct oil to chemical, what's your view? Or any other emerging technologies in the petrochemicals? Your views on that?
Okay. I'm not a technologist, therefore my mine will be a little more, let's say, finance, business kind of this thing. But at the same time, we also happen to be, in within our group, we happen to be having Lamas, which is one of the largest petrochemical technology supplier in the world.
Right.
And Lamas is also at the forefront of supplying the O2C crackers. So therefore, by
Right.
and by being a part of the organization, I have learned a little bit about it. And I think one of the O2C is one of the most exciting technologies that has that has come up in the recent and not so recent past. And essentially, what it does is that at one place you basically crack straight away crude, and then you decide what cut you want. You if you want, and then you can of course, with a certain you can create flexibilities around whether you want fuel or you want petrochemicals, and within the petrochemicals there is a at least a certain amount of capabilities of being able to determine what petrochemicals you want. So therefore, in a scenario where the margins on the various polymers and chemicals and fuels is changing very rapidly and very drastically between week on week, month on month, it does give you a fair amount of flexibility. That's number one. Number two, you obviate the need for having to crack crude to get naphtha, etc., and then transport the naphtha somewhere else and then produce the various chemicals out of it. So therefore, you obviate that need, and therefore there is a fair amount of saving on the logistics costs and the storage cost, etc., etc., and then also even working capital, because whenever you produce, store, create a tanker load and then transport, and the whole of it, there is a fair amount of working capital involvement in that, so you save on that also. And then the energy efficiency, and ultimately crude cracking is also an energy is an exothermic reaction, so is naphtha cracking. So therefore all of the so therefore you when you do one input crack to for a multiple output products, therefore you do gain certain amount of energy efficiency. Therefore there are a lot of efficiencies as well as flexibility as well as saving in the logistics and the working capital, so it does work out to be pretty good in terms of its overall economics and dynamics, etc. And of course, I mean, technologically it is a lot more complex because you are trying to get a large number of products through a monolith kind of a large volume going into a set of crackers. So that's
Right.
my layman's understanding. It's
Right.
very very it's very good, and at the same time technologically it is a lot more complex, and your economic size is much larger.
Correct. Absolutely. Absolutely. But in this backdrop, how do you see the existing plants? Because existing plants are not based on O2C. It is largely through a refining route it happens. Will it be a threat to the existing plants which are designed based on the refining route?
Not too sure, because ultimately any new plant will also be coming at today's cost, whereas a lot
Correct.
of existing plants are at a historical cost. Therefore, of course, it will give flexibilities and benefits. I'm not too sure that the benefit will be so much that it will be able to price out. And then the other thing is that being a large size plant, you will put it up at one place. Therefore, if you put it up one place and if you have to serve the world out of that plant, then you will have a local matters to deal with, and B, then your logistics cost of feeding the markets will then go up.
Understood.
And then the other thing is that uh, while of course a $10 per ton also makes a difference in your profitability, but $10 per ton will not decide whether a plant survives or the other plant survives.
Correct.
So
Absolutely.
they may just be more profitable and more resilient to the business cycles.
Right.
But I'm not too sure whether they will kill the existing plants.
Right. So, a follow-up to this, my question is for Mr. Thakkar. As he said, it all depends on what exactly you set up a plant and which segment you cater. So, how do you see the demand-supply position in the country, especially you are coming from the western side? How is the demand-supply position in the western side vis-a-vis the other parts of the country? If you can brief us around that.
So yes, western side of India, I think we are seeing a lot of tractions on the various industries being set up. Especially Gujarat, we have seen entire large mega complexes is coming up in Dholera and semiconductor industry side. Automobile is coming up in large ways in Sanandi region. So the age becoming very large for the petrochemicals and chemical side. And now what we are seeing that near to the Mumbai and Vapi areas, there is another big cluster is coming up because of a new port is coming up there. So yes, we see a lot of tractions for the chemical, petrochemical. Of course, Gujarat being a large hub of pharma along with Andhra and other places. We see a lot of new demand is expected to grow. And as we see that, new capex is coming up in this region, demand push will happen out of that particular business as well. So western side is of course very attractive place right now for the these petrochemical businesses.
Right. Absolutely. And my question is for you, Mr. Gupta, before we move on to take the audience questions. Uh, what is the potential impact of this ongoing geopolitical uncertainty, reciprocal tariff, as far as petrochemical sector is concerned? Do you see any major challenges out of this?
I cannot talk about the overall petrochemical sector, but if I was to look at within polymers,
Yeah.
we did actually a sort of bit of a balance between saying that okay, what are the main export sectors of India, and out of those sectors to US, and out of those sectors what may get impacted, etc., etc. So we did a shadow analysis. We figured that significant one. See, even if US is 17%, and then out of that 17%, to the extent of gems and jewelry, in any case, there is very little impact on the petrochemicals, on the textiles. There may be some impact on the packaging side, etc., etc. Unlikely that there will be a very significant impact on account of at least the additional tariffs that are there on India. In fact, at least based on our analysis, the push on the demand side on account of the GST cuts more than offsets the potential downside on the additional tariffs that have come in from US to on the Indian exports. So therefore, they sort of balance out with a marginal positive. But the fact is that in general, like it is true for any other business, when all these geopolitical uncertainties and the constant changes in the tariff, and on again, off again, which side Mr. Trump woke up from today and which side he will wake up from tomorrow. So they do create a certain amount of uncertainties in the business. But now we are down 9-10 months. I guess you learn to live with that.
Right. So I'm sure the audience has been anxiously waiting with some interesting questions. So let me start taking the questions from the audience now. First question, any discussion is nowadays incomplete without discussion around AI and ML, artificial intelligence, machine learning. So Mr. Thakkar, if you can respond to this, the question is, how is digitization, including AI, IoT, predictive analytics, being implemented in the petrochemical plants? And do you really see any meaningful benefits from this?
So I think it's first disclaimer, as I think Pramodji said, we are finance folks, But having said that, yes, things is moving in that direction. We've seen that, especially on the maintenance activity side, there's something called digital twins, which is being used nowadays, which is actually nothing but it's a replica of our plant in a 3D model, and that will be used going forward for the really seeing that how we improve our maintenance activity in better way, to see that our plant are running more efficient way, to see that we have the best energy use, I'm saying lowest energy use, to produce whatever the product we produce. So yes, we are moving towards that. I think large refineries has invested in this. We are seeing the medium-sized companies started investing in this, and they have started investing historians, process controls, and the next step is AI and ML. Yes, so that investment is going on at a pilot stage, and gradually, it will be used very extensively.
Agreed.
Yeah.
Next question is on the quality control orders. So, Mr. Gupta, you already briefly touched upon this, I think, during your response to one of the questions. The question is that recently we saw QCOs being withdrawn in the textile, steel, fertilizer, and petrochemicals. So how do you see the impact on various petrochemical manufacturers in the country? And the question is saying that QCOs were meant to tackle the cheap imports or poor quality imports. It was mainly to tackle that poor quality imports, not the cheap quality imports. So how do you see this
No,
QCO
I
withdrawal?
intrinsically agree that the protection needs to be from poor quality imports, and therefore because the cheap quality imports have to be in case they are in the nature of dumping or in the nature of coming in from locations which have got intrinsic feedstock advantage. Like if there is a Middle East producer selling in India, they can go down to the prices which an Indian producer can never match, because they are producing right at the head, and they have the infinite flexibility of either selling crude or an intermediate or a final product. So therefore that kind of benefit, and therefore that the government, so those kind of things government has to look at in terms of saying that, okay, fine, do I want to be import dependent, or do I want to strategically make sure that I am not deprived of my key raw materials in times of emergency or urgency? Because we have seen that in times of disruptions, respective state, country governments then prioritize their own well-being rather than another country's well-being, and therefore, but if you kill your industries during the good times, then in bad times you have no option but to be dependent on outsiders. So therefore, I agree that QCOs cannot be a response to a cheap import, but QCO needs to be a response to the poor quality imports. And while we do agree that what the objective of QCOs is to make sure that Indian consumer doesn't suffer,
Correct.
but Indian consumer, unlike the Western consumer, is not very evolved, and therefore they do get impacted by poor quality products that get produced by a very large number of people who are more focused on their financials rather than on making sure that the customers do get good quality. And therefore, how do we differentiate between poor quality and good quality but cheap is a question that we have to answer as a country and as a government.
Correct. Absolutely. Similar views we also get from the other sectors also, wherever QCO withdrawal has happened. So we also echo to that. Next question is for you, Mr. Thakkar. Amidst the profitability challenges which we saw last couple of years, profitability has been a challenge. So how is the balance sheet management by the industry players?
So I think, as I said, FY23-24 was a good year for the industry. Post-COVID 21-22 onwards, it was good year. We have seen a lot of deleveraging happen on the balance sheet front, and we again seen that capex cycle has started. The best thing is to really see that we face the capex in the right way. Second is to really see that we get into the entire value chain. Third, we get into the right place for the businesses because location is very important. And fourth is of course to see that we have the right instrument for funding this kind of capexes and don't go to large debt. So I think this is something which we always apply in our business strategies, and it worked well for us.
Right, absolutely. I think the balance sheets have been still lean and clean, which
Yeah.
is actually helping the sector.
Yes.
Next question is for you, Mr. Gupta, especially because it is related to the phenol. Question is, what is the current scenario in the phenol segment, and will the margins improve in the sector from the current scenario as new capacities are also coming up in this particular product line?
We are not yet in phenol. I think Deepak is in phenol. So maybe
Yeah,
this
I
question
mistaken.
should go
Yeah,
to
I
Mr.
mistaken
Thakkar.
that. Yeah. Correct. Mr. Thakkar, if you can respond to this.
So yes, see, we have seen that spread has contracted, but this is bound to happen. And the one of the reason which I said that a lot of capacity has come up in China, and we are also seeing that capacity is coming up in India, which definitely create more challenge. But see, when we put up this plant in 2018, post that there was a huge demand increase has happened. So post our coming into the market, our growth on the CAGR of demand growth was higher side. So having said that, consumption side, we are not seeing a challenge. The prices is subject to global prices, and China has come up with a large capacity, which definitely affect global markets,
Right.
and
So
which is going to run for not a short term. It may run for a bit longer time.
correct. Absolutely. So for paucity of time, this is the last question which we'll be taking. And Mr. Gupta, if you can respond to this.
Yep.
How beneficial China's anti-involution campaign could be for India, whereby more than 30 years old plants are expected to be phased out by 29. So we see significant addition has happened and which has actually created this trouble across the world and especially for
Mhm.
India. Now some of the plants are going off by 2029. So will it improve the situation globally as well as for India, or what's your view on that?
So, in any case, I mean, we also keep hearing about that anti-involution, and that is actually going to have two benefits. And of course, for China, but also for the world. One is that it will also improve the pricing and the economics of their consumption industries within China, and therefore their ability, their paying capacities will go up. And number two, within petrochemicals, whether polymer or other downstreams, when there is a capacity closure, and of course that is also environmentally beneficial, but that will overall improve the global operating rates. And the fact is that, as we have discussed earlier, also the India capacity, I mean the demand is anyways growing, and therefore there is no issue on the demand, and it's a pricing issue which is impacted by the global operating rates. So anything that improves the global operating rates will have a benefit for all the players, whether they are in India or anywhere else. But we should also keep in mind that apart from China, there is a very significant capacity rationalization that is happening in North and Northeast Asia, as well as in Europe. So therefore, we should not keep in, while of course China focus is important because it is the big daddy, so to say. But there are very significant rationalizations that are happening as we speak between North Asia, Northeast Asia, and Europe.
Yeah.
So it's an interesting time, honestly.
Right. So Europe also we see that some of the cracking capacities are going off. So yeah, definitely. Thank you again to our guest speakers for the insightful views, and it was an absolute privilege to host you all. I'll now hand over to Mamta to give her concluding remarks. Over to you, Mamta.
Thank you so much.
Thank you, Hardik, for steering such an insightful discussion. A heartfelt thanks to all our distinguished speakers, Mr. Thakkar and Mr. Gupta, for sharing their valuable perspectives on the current dynamics of the petrochemical sector. It was truly an honor to have you with us. And to our participants, thank you for joining and engaging with us today. We look forward to your feedback. For any further queries, suggestions, or comments, please feel free to respond to the feedback mail you'll receive shortly. That brings us to the end of today's CareEdge webinar. Goodbye for now. Requesting the tech team to kindly log off.
Thank you.
Thank you,
Thank you.
everyone.
Thank you.
Thanks.
Thank
Bye.
you. Thank you, sir.